This is quite possibly the most important trading video that you will ever watch because we're going to be running through Japanese candlesticks. And these candlesticks are at the very core of technical trading. They're what your charts are made up of, and being able to read candlesticks and understanding the different patterns and use cases will give you a huge edge in the markets and allow you to see what's happening at each minute, hour, and day inside of the markets. So whether you're a beginner or you're already versed with trading, this video is going to provide you with massive value. Stick around all the way through and I will take you from 0 to 100 with Japanese candlesticks. A candlestick is one part of the larger picture that forms a candlestick chart. Candlestick charts are the charts that we use to do technical analysis. They look just like this, and these individual candles make up a big picture. What they show is price movements over a specified timescale, and they give you an insight into how much price has moved within a specified time frame. We'll get more onto that soon, but first let's take a look at Candlestick Anatomy. So here we have two examples of candlesticks. We have a bullish candle and a bearish candle. Now a bullish candle shows price increases within a specified time frame, and a bearish candle shows price decreases. Candles are made up of two different elements primarily. We have a candle body, which is this large block-like part of the candle, and then we have candle wicks, which are the small sticks that stem out of either side. The candle body shows confirmed price movement within a specified time frame. So in the case of a bullish candle, the open price is going to be at the bottom of the candle. This is basically where the market opened at the time that this candle began. So if we were looking at an hourly time frame, that means that each candlestick we look at shows us 1 hour of price action. So if this was an hourly candle, this would tell us that the market opened at 1.08120 and then closed at 1.08520, which shows a 40 pip increase within that hour of trading. Now, a bearish candle simply shows the opposite. When we're looking at a bearish candle, we are seeing a market that opened high and closed low. So in this example, we open at 520 and we close down at 120, which would show a 40 pip decrease in the price of the asset over this 1 hour. Now the wicks show rejected pricing, which simply means that within this hour, the market attempted to go higher towards 1.08560, and it also attempted to go lower into 1.0865. However, the market failed to close this low or this high, which means this pricing was rejected. The bearish candle is exactly the same. The wicks are just showing attempted price ranges, but the market didn't close down here or up here. It first returned back to this level before closing. Right, so as I said, candles show price movements over a specified time frame. We're looking at Euro USD here. This is a 1 hour time frame, as you can see up here. Now, being on that hourly time frame means that each individual candle we look at shows 1 hour worth of price action. So this is how much price has moved in the current hour. This large candle here is how much price moved in the previous hour, and so on and so on and so on. So what we can do with candles is actually view the market from many different time frames. We can see it from a big picture perspective and a smaller, more refined perspective as well. Now, if you take a look here, if we block off these past two candles worth of price action, and then we go down to a lower time frame, you'll see that within these two candles, there are many more smaller candles. So on the 30-minute time frame, there are 1, 2, 3, 4 candles within where there would have been two 1 hourly candles. And if we go to the 1 minute time frame, there will actually be around 120 candles within this range because 2 hours is going to be 120 minutes, meaning there will be 120 individual candlesticks happening within those larger candles. So when we go down to this time frame and the markets look completely different, it's not that it's a different market. In fact, it's showing us exactly the same price action as this is just here. But the difference is we're seeing a more refined view, which means we get better insight into what's happening on a smaller time frame perspective. This is useful for day trading and collecting more information on the different pairs. So timeframes are important to note throughout this video. We're going to come back to this, but I just want you to be aware we can look at pretty much any time frame all the way down from the 1 second up to as many months as we want, even a yearly candle if we wanted to, which would show us 12 months of price action. When we're looking at a candlestick, what we're really seeing is the battle that's taking place between buying and selling in a market. When there's more buying than selling taking place, the markets will go up. And when there's more selling than buying taking place, the markets will go down. Candlesticks are so good because they allow us to see this battle taking place in real time. So if we look at this bullish candle, for instance, it's showing us that buyers took control at this level and sellers failed to maintain the buying until this level here. Now, rejections show that sellers did attempt to push the market down to this level, and they also managed to reject price from closing this high. So there are sellers active in this market, as indicated by the fact that we didn't close all the way up here, and as indicated by the fact that the market dipped a little bit before pushing up. But we can clearly see in this example that buyers are in control, because the close price of this candle was higher than the open price. Now this leads me on to the point about candlestick momentum, which is by far the most important way that we're going to use candles in our trading. So looking at this candle here, we know the market opened at this level, it closed at this level, which means this is a bullish candle where buyers were in control of the market. However, not every single candle is going to look like this. Some candles will look a little bit more like this, and others may look like this. Now, a candle that closes like this, with no wick at the top, is an incredibly strong candle, because it means within this 1 hour or any specified time frame worth of price action, we saw no resistance from sellers. Okay, the market closed as bullish as it possibly could. Bullish is buying strength, by the way. So because we saw that incredibly bullish close up here, we know the buyers are solidly in control of this market. And what will usually follow on from this is a further continuation of upward price action. Because we're seeing the buyers are in control completely, there's not really any reason for the market to reverse here unless sellers push in with a lot of pressure. So strong candle bodies can show very high momentum from buyers or sellers. Now, if instead we were to see a candle like this with no lower wicks, that would show considerably strong selling pressure because we had absolutely no resistance from the buyers and the market was able to close as bearish or as strong on the sell side as it possibly or physically could. Now, wicks can also give us a very good picture, and in fact, wicks are the most important part in reading momentum in a market. It's also a lot more common to see wicks than it is to see a candle this weak or this strong. So let's talk about wicks for a moment then. If we see a candle that looks like this, where we've attempted to go considerably higher, but then been pushed all the way back down, what this is actually showing us is a market that could potentially be reversing from the buy side into the sell side. And the reason for that is we've opened at this level here. The market has attempted to push all the way up here, but then there has been a significant amount of sellers kicking into the market here, which has managed to reverse all of the price action of this candle and actually close it lower than it opened. So this shows a phase of reversal, where the strength is leaving the side of the buyers and moving into the hands of the sellers. When we see a huge reversal taking place like this, we clearly now understand that sellers are in control of this market and they've just taken over. So if we see a candle like this from a meaningful area, which we'll discuss very soon, it's quite highly likely that this is going to lead into further downside price action. The same goes for a candle that went the other way. So a candle like this, for instance, with a bullish open to close, which means we opened at this level and we closed at this level, shows a bullish reversal. So this huge attempt to push lower, indicated by the wick, is telling us that the market opened at this point, it tried to move all the way down here, buyers took control of the market at this level, and we had a huge reversal closing bullish, so closing even higher than the open price just here. This obviously is showing reversal from selling control into buying control, and as you can probably imagine, this is the kind of price action that is likely to lead into continued upside. Now, what happens if there's equally sized wicks either side of a small candle body, like this? This is what we call an indecision candle. So basically what we see here is an open and a close price that are very close to each other, and we see huge wicks which have pushed both ways. So if we try to think about what this candlestick is showing us, and this is what we should always be doing, reading into what the candle is telling us, it is saying that we opened at this level, we attempted to go considerably lower, we attempted to go considerably higher, but in the end we closed very near to where the candle actually opened. Which means at this point in time, this market is pretty much just showing a phase of indecision. We don't have clear control from the buyers because the market has rejected all of the buy side price action attempts, and we don't have clear control from the sellers because the market also rejected all of the selling attempts as well. So this is an indecision candle, and it basically shows a phase in the market where neither the buyers or the sellers are in any control, and this is where things get interesting. Because when we don't know who's in control, we don't know which way the market is going to go. but these can be really solid to see at high interest reversal points. So what these indicate is not a confirmed reversal, but the first signs of a reversal. Let's take a look at an example of that candle in real context. So we can see here the market has approached a key level, whether that's a resistance, a supply zone, anything of the like. We're not going to worry about that too much just yet until we get into some examples in a bit. But we've approached a key level, we saw a small wick above, then we saw an indecision candle. The market opened, attempted to go higher, attempted to go lower, and ended up closing pretty much just around the open price. So we can see that this is now a phase of indecision. So as we just said, indecision candles are not going to confirm a reversal, meaning we shouldn't immediately look to sell a market like this just because we have an indecision candle, but it can give us the first insights that a reversal may be underway. So if we did see this, we would generally anticipate that this candle is going to be followed by a bearish candle, because it's basically looking like we've lost all momentum at the key level and the market may now be ready to reverse. So it's after we start to see bearish price action that we can start looking for the short opportunities. But the reason we don't want to rush to immediately sell indecision candles at key levels is because they can just as easily continue bullish with the larger trend. Now, indecision, as we know, just shows a phase where the market hasn't decided which way it's going yet. So it's just as possible that instead of going short, the market rallies once again. Okay, it just depends whether the buyers or sellers take control during this phase of indecision. So now let's take a look at some of the other examples. What would you expect to see if we saw this at the key level, based on what I've already told you? Well, what we would generally be expecting from this point would be a reversal, okay? Because what we're seeing is an attempt to go higher, completely rejected by price, meaning sellers are kicking in at this level, and sellers have brought us all the way back down to pretty much not close above the key level or not close over the previous candle. This is obviously showing a massive push from the sellers, which therefore means the next candle is quite likely to be a bearish one. So this can be indication that we may want to start getting into some bearish trades. Now on the flip side, if the candle we were looking at closed like this, what would this tell us? Well, this would tell us that buyers are in control of the market. This key level was of no interest to these buyers, and buying is most definitely stronger than selling right now because we have of course managed to close above the key level. So in an instance like this, we wouldn't be expecting to see the market then reverse down into lower price action, but we would instead expect this market to continue buying because the key level has been totally ignored, showing massive strength from the buying party in this market. So remember guys, when a market closes with strength like this, showing very little rejection from sellers, this is showing a market where buyers are clearly dominating. If the market instead closes with indecision, this is showing a market where no one is really in control just yet. So we want to wait for new signs to see whether the sellers or the buyers are going to take control from here. And if the market is showing large upper wicks like this shows a phase where the sellers are taking control, which is the highest likelihood of us then leading into new selling movements and one of the best opportunities for us to start looking for short positions. Now you might have seen that there are about 100 million different candlestick patterns that you can start to learn. In my opinion, these are totally useless. We should really be focusing on that battle between buyers and sellers rather than trying to memorize 100 different patterns. There is one pattern I like, however. So before we move on to some real trade examples, let's quickly cover this engulfing candlestick pattern. So this is the only candlestick pattern that I think is really worth learning in and out from a trading standpoint. Now, what an engulfing shows is where buyers have taken control of a market from sellers, or where sellers have taken control of a market from buyers. Now, the format for an engulfing candle is very simple. The candle body of, in this example, the bullish candle, must be engulfed by the candle body of the bearish candle. So if we see this, we are actually seeing a phase where the buyers have been totally wiped out by the sellers. The same goes for a bullish engulfing, but here we are seeing a phase where the entire bearish candle is being engulfed by the bullish candle. Now, the reason that I like engulfing patterns, and I think these are worth learning, is because they're actually showing us market structure. So market structure is a theory relative to trends, where if we are seeing the market print continual higher highs and higher lows, we're in an uptrend. And if we're seeing a market print continual lower lows and lower highs, we're in a downtrend. This is a very staple price action trading concept. If you want to learn all about this, there's a card in the top of the video taking you to a structure class. So your general bearish engulfing pattern is going to look something like this, right? Now, if we're looking at this from a structural perspective, basically what we're seeing is the market come down, print a low, print a lower high, then print a new low, and then this push up prints a higher high. So what we're seeing there is a break in structure at pretty much this level. So if we eliminate the candlesticks from this for a moment and we focus in on the structural shift that we're seeing, what we actually see with an engulfing pattern here is a break from a downtrend into an uptrend, which is where we would ideally like to be getting into new trades. So at this point, we would then be looking for pullbacks to buy from to lead us into new highs. So if this bullish engulfing pattern happened from a significant key level, for example, such as a demand zone or a point of liquidity, then this would indicate a confirmation that we want to see to get ourselves into a trade. And it's this break of structure here with the closure above the previous candle that is giving us that confirmation. And the same goes for a bearish engulfing, right? We are seeing a push up, then we are seeing a higher low print, we're seeing a higher high, and then the bearish candle that engulfs the bullish candle is actually showing us a point of which structure has broken on the lower time frames. So in the case of a bearish engulfing, we are seeing that lower time frame break of structure, which can lead into a pullback selling opportunity. Now, another quick note while we're on this topic is that you must always see the market close above a high or below a low to validate an opportunity. So if we were looking at this bullish engulfing example, we wouldn't want to immediately buy if we just saw this happening in the market. Because until this candle closes, it could go higher, it could go lower, it could do whatever it wanted. So if we entered the trade here while this candle was still active, and then the market went and closed down here, well, we're taking an invalid trade now, because we are not seeing a closure where we want to see one. In fact, we're actually seeing closure in the bearish range, and we're seeing rejections up here, which means this is a very low probability point to buy from. So in order to validate trades, when you're looking at structural points like this engulfing candle here, you always want to wait for the candle to close. So if this was an hourly time frame, let's say this is 11 a.m., 12 p.m., 1 p.m., we need to wait for 2 p.m. before we take any action. Because until 2 p.m., this candle can do whatever it wants to do. And if it ends up closing down here, you can be damn sure we do not want to be buying. So just keep that in mind for everything we talk about. Candlestick closures are important. A candle is not validated until it has closed and a new one has opened. So I just want to give you a bit more context on using structure with candlesticks. Now, as we say, when we're looking at candlesticks, we always want to consider the market structure. Now, in this instance, if we map out what we're seeing here from a candle perspective into market structure, we are seeing a downward phase, a lower low, a lower high, and then we are seeing a continuation of lower price action. This can be plotted onto the candle chart like this. We see the market come down and formulate a low, we have a pullback to a lower high, then we have a continuation to the downside. So in an instance like this, we know the market is trending down. Now when we see a downtrending market, our goal is to continue selling. So we can look for the market to pull back, and then we can find a selling opportunity, which allows us to use the indecision candle as what we would call a supply zone. So a supply zone is an area in price before a large downward move, and the concept is when the market returns to this level, we will therefore look to sell. So this indecision candle or doji candle becomes a supply zone because it's an area of consolidation before a large down move. So now if we were looking for trading opportunities, a pullback in would provide us with a selling opportunity. Now, in an instance like this instead, where we have a bullish candle following the indecision, we can also consider this from a structural perspective. We have the market printing a low, we have a lower high, we have a lower low, then we have a higher high. So this one, of course, is also an engulfing pattern. We've engulfed this previous candle. So just here is the break of structure that we want to see. We are looking at something like this, which indicates a shift from bearish to bullish here on the lower time frame. So our goal is, of course, to buy the pullback. So if the market pulls back down, we would then look for a long opportunity. Now that would lead us to potentially target this doji candle or indecision candle as our demand zone instead, which is just the opposite of a supply zone. So if the market came back to this level, we could look for a buying opportunity like that because we are seeing now that structural shift happening on the lower time frames. Now it's important to always consider the context that these movements are happening within. If we see a movement like this just randomly in the middle of a trading range, not coming from any meaningful areas, then buying here is rather unlikely to succeed. The market is very rarely actually going to go down solidly. It will always have pullbacks on its way down or up, which means that this could easily be overwritten with a bearish candle here that would lead us into new lows. So what we want to make sure we're doing is trading this kind of pattern and any of the patterns we've covered so far from meaningful areas. So if this reaction took place at a support of some form, whether that was a higher time frame demand zone, a point of liquidity, or any other point that you like to buy or sell from, then it becomes interesting and then it becomes viable for us to start using it for trading opportunities. Context is important whether you're looking at buy trades or sell trades. Candlesticks should always be used in context. So now let's go take a look at some trade examples following each of those three core types of market movement. Right, so let's focus in on this piece of price action we're seeing just here. So we can see we have a push down in the market. This is a bearish phase of price action. Then we come down to around this level just here, and we start to see a push away from the buyers here. So we are seeing multiple wicks showing potential reversals in the market. These bearish candles are reasonably large, but they all have wicks on the bottom, which shows there is definitely some buying pressure pushing back against the sellers here. Now, when we reach this level down here, the buying pressure kicks in more dramatically. We see multiple large wicks, and then we actually see a closure up here. So we've actually engulfed previous candles here. So take a look. This bullish candle body has engulfed this candle, and this candle, as well as this smaller doji candle as well. So this engulfing is showing that shift in structure that we like to see, where the market has formulated these lows and then shifted here into this buy side movement. Now, with this being an indecision candle that we're focusing on, as we know, the market can go either way from this. And based on the example I just showed you with the context we now have, we could use this indecision candle as a demand zone. So just like the example I showed, as you can see, we push away here, indicating that reversal. The market then pulls back into the boundaries of this area here, this indecision candle. Then we have a bullish push away. So using the other concepts that we wanted to use, whatever they may be in your trading, your buying opportunity could have taken place from here and taken you up towards some previous highs, which of course, as you can see here, would have been filled. So obviously we want to use candles in line with other systems, but by just simply reading the candle momentum here, we saw that shift in the pressure from sellers into buyers, and you see that buying opportunity that took place subsequently as a result of that. So now leading into this piece of price action just here, what do you think is likely to happen based on how these candles are printing? We had a push down to this low, we had a light closure through the low, followed by a large bearish wick rejection. With this wick rejecting bearish prices, it tells us that buyers are stepping into the market here. And then we have this very large bullish candle. Now, if we look at the boundaries of this bullish candle, we can see that this candle has engulfed multiple previous candles. We have engulfed 1, 2, 3, 4, 5, 6, 7, and then this entire range worth of price action as well, showing that this buying pressure is incredibly strong. Following this bullish candle, we have an obvious phase of indecision, which is taking place on these two bearish candles. We have a large push away on the first candle, a large push down on the second candle, but all in all, we are confined within the range from this low to this high between these two candles. And following that indecision phase we get there, we have another large high momentum bullish candle. You can see that the wick at the top here is insignificant in comparison to the size and strength of this candle body, therefore showing that the buyers are in control here. So what we would look to do in this instance, if you haven't guessed already, is use that indecision zone as our potential buying area. We know now that the buyers are in control because we are seeing a break in the structure once again. We're seeing an engulfing of these two previous candles, continuing this large bullish surge we're seeing, and we don't really have any resistance up here for a trade opportunity. So now we would look for a pullback into this area, and we would use that for our buying opportunity. And if we allow the market to play forwards, you will see that is exactly what we get. We get the market trading down and tapping into this demand. As you can see, we fail to even close in this indecision area. We have buying pressure, buying pressure, buying pressure, a final push of buying pressure, and that leads us into this large bullish upward move. So you saw there how I dug into what the candles are actually showing us. I'm constantly aiming to read the battle that's taking place between the buying and the selling in the market. And the best way to do that is to simply look at the candles that the market is printing and work out, are we seeing buying pressure, selling pressure, or indecision? And then using the information that the bodies and the wicks tell us to identify which way the market is likely to go, and then hopping on those trading opportunities using the very format that I just presented to you. The momentum of a market is not only seen by individual candlesticks, but can also be seen by ranges of candles as well. Now let me break that down for you. Here on the chart we can see a bearish phase that then leads into a bullish phase. But what can you tell me about what we're looking at here? Well, we can quite clearly see that this bearish move is fairly indecisive, right? It's slow, it's choppy. We have wicks around the candles. We're not seeing a significantly decisive bearish movement here. We are seeing a slow chop to the downside. Now then, following on from this slow chop made up of multiple candles, we see this bullish phase. And what can we see in this bullish phase? This is quite evidently stronger than the bearish phase, as indicated by the size and the velocity of these candles. And not only that, but also the fact that there's only 2 bullish candles here compared to 5 bearish candles here. Now, we don't need to specifically read into how many candles a down move has or how many candles an up move has. But if we think about this from the perspective of timing, through this phase here, we are seeing 5 hours of bearish price action. And in this phase onwards, we are only seeing 2 hours of bullish price action. Yet the 2 hours commencing here, we had a considerably larger price movement, which means that the buyers are more in control over these past 2 hours as the sellers were for the previous 5 hours. Now, this in itself tells us something. It tells us that the momentum that's kicking in at this point onwards is considerably stronger than the momentum that kicked in previously around 7 hours ago. So when we see a range that is slow and choppy, that indicates that the selling pressure that we're seeing there may not be as strong as initially anticipated. And then when we see these fast movements, we are seeing a point in the market where significant control has stepped in. So based on what I just covered, take a look at this market. What do you see? Well, here we have a bearish phase that is relatively slow and choppy. Okay, you see we are pulling back continually. We are failing to make much ground at all. And then we come down to the end of the phase just here, where the market then rallies away with this large bullish upward surge. So when we look at the timing, we can see from midnight all the way through to 7 a.m. or 7:30 a.m., the market was bearish. That's around 7.5 hours of bearish price action. And then in the following 1 hour from 7:30 through to 8:45, we saw this dramatic bullish surge. And not only is this bullish movement happening very quickly, but it's actually overwritten and engulfed the entire previous trading range. So you can see from pretty much where we began all the way down to this level has now been entirely engulfed by this push that we have to the upside. The buying that we're seeing now is considerably stronger than the selling that we were seeing previously. This provides us with buying opportunity. We have, number one, an obvious area of buyer control. Number two, we have that structural consideration of breaks of structure, where we are seeing multiple of the bearish highs being broken by this bullish movement. And number three, we have that small phase of indecision that then led into this large move, which would act as our buying area or our demand zone. So using this area as our demand, we would now look for this to be our buying entry, and we would look to take the market higher once it retests this level, because we've now seen a clear shift in control from selling and weak selling at that into strong buying. So if we place an order just there, you can see the market comes down, trades into that area, retesting that low, and then we get that push away, leading us through to our targets. So that's an example where you can use pretty much all of the concepts we covered so far, in line with, of course, that slower bearish trend and faster bullish trend, indicating that the buyers are now likely controlling the market. So here's another trade that I took recently. For this position, I'm only going to focus in on the candles, not the larger picture and the reason why I took the trade, but we're going to look at just the entry from a candle perspective. So you can see after trading into the point of interest hit, we had a strong bearish candle close. This candle here, we had absolutely no wick either side of it, basically. Okay. After that, we had a very slow, choppy, grinding upward move, which traded us back towards this point here, which would indicate as a supply. Then we had another significant bearish candle with little wick at the bottom, practically no wick at the top or the bottom. Clear control from sellers here and here as well. Then we have once again a slower, choppier, more grinding upward move, which capped out once again at the indecision candle there, being the kind of supply zone. Now my actual entry was taken just after the close of this candle. If we zoom in on this candle, you will see that it engulfed the previous two candles. So after trading into the supply, we had this bearish candle, which engulfed this one. We had two small bullish candles, and then another bearish candle here, which engulfed both of these, which leads us to believe, especially with no wick at the bottom, that we are seeing sellers take control here. So after the closure of this candle, I sold the market, and as you can see, we rode a new bearish trend all the way down to fill the next point of interest, which was my target, for a 5.24% return. And this was practically purely using that candle momentum to get into this position. If it wasn't for candle momentum and I didn't understand the theory, there's no way I would have taken a trade here. We have strong, clear selling control and very slow, difficult pullbacks up, showing the buyers are considerably weaker than the sellers here. Pairing that with the fact we traded out of a point of interest, this becomes a very nice high probability opportunity. And as you can see, after getting in, I had no drawdown. We just went straight for the target. Now I want to show you how you can avoid taking bad trades by using the same candle momentum theories that we've discussed so far. So in this example, once again, I won't go too deep into context, but I was looking for a selling opportunity if the market pulled back to this area. So this would be my supply zone. We saw a dramatic, strong sell-off. The market printed just about a new low here. And I was thinking if we can pull back towards this region, this would be a good point to sell from. I had my plans to sell from this zone with a stop above to target new lows. However, after formulating this range down here, which pretty much didn't achieve anything, we just moved back and forth sideways, we did see a very large bullish candle. Now, if we consider what this candle is telling us, it's showing us that at this area down in the lows, we are seeing a significant influx of buying pressure. We've seen a huge bullish candle, which has engulfed countless amount of candles previous to it, all the way from this candle onwards has now been engulfed by one single bullish candle. And there's no wick at the top. There's a very, very tiny wick. So we're not seeing significant rejections like we did previously, okay? You can see these wicks are larger at the top of these price moves. The one on our supply zone is larger as well. But here we have a tiny wick, literally minuscule compared to the size of the bullish candle. So that tells me that here, from this point onwards, buyers have taken control of this market with massive force. So now I can take this as a sign to not sell the market. If my plan was to sell before, I pretty much know now that if I do that, I'll be fighting the controlling party, which is quite obviously based on the engulfing and based on the size and velocity of this bullish candle, as well as how much ground we covered in such a small amount of time. We now know that the buyers are controlling here. So selling is to battle the market. If we sell, we are going against what the market is telling us to do. So I avoided selling here, and as you will see, turned out to be a brilliant move because this trade would have been a pretty much instant loss. Now, not instant in terms of timing, but pretty much no profits whatsoever would have come through on this position. No opportunities to go break even, no opportunities to bank a profit, just a straight up loss, which was fortunately completely avoided by the fact I took the initiative here on the momentum and understood that this bullish candle indicated a change in control, and selling became the wrong thing to do. So that's it. That's pretty much everything you need to know about candlesticks. Now, if you want to learn all about trading and become profitable, get results like this, and this, which are all just from the past week, and get access to all of my trades, like the one that I just showed an example for just here, then you can do so in my Trading Academy. Check out the top link in the description for that. There's also a free course if you want to start there. And with that said, if you enjoyed the video, please do be sure to subscribe because I make these videos every single week. And if you feel like it, drop a like because it helps me out. So thank you for watching. I hope you found a lot of value, and I'll see you in the next video.